Hey, everybody, good weekend. Welcome to your Market Minute for Sunday, the 4th of August. I think this week you're going to start to hear more and more about what's called the carry trade. This is the chart of the US dollar versus the Japanese yen. And the Japanese yen up to this point has been relatively inexpensive. Their interest rates have been low. So you borrow yen at these low rates, and then you take those funds and then you invest them in a higher interest rate environment. This has been happening for years. So what I'm going to talk about today is a little bit of what I see as history repeating from nearly 20 years ago. So this is a situation here back in '07 where we had the same kind of thing happening. This positive relationship between the Japanese or the US dollar and the Japanese yen all of a sudden broke lower during around the August timeframe of 2007. This is when markets were starting to fall to pieces. And we're seeing the same thing happening now, but just on a much grander scale. Of course, you know what happened back here in '08 into early '09, right? So this is where things really, really fell apart. And so we're actually much higher right now. There's more leverage than there ever has been, which is being unwound, and this is affecting financial markets nearly worldwide. So here's the S&P 500 on the daily chart. And back in this is almost the same time frame, right? Back in the mid-July time frame in 2007, we had parked out here at all-time highs on the S&P, which at that point was 1555. And then the carry trade started to unwind. And we got to this point on this date here on the 16th of August in 2007. And up to that point, the U.S. markets had been in, I guess, a rising rate environment, which had stabilized as of around 2006. So rates have been going higher, quarter point every time, and then they stabilized rates, were pretty much flat. And so on this day, what happened is the Fed had a conference call and Chairman Bernanke basically said, yeah, we're thinking about dropping rates by 50 basis points. And of course, what created that was a hammer candlestick. We were much lower earlier in the day. It looked like the market was really falling apart. This is the first 10% correction that we'd had in several years, since the bottom in 2003. And so this is 4 years later. This is the first 10% correction that we'd had. So markets were very quiet up to this point. And so this was a big shock, seeing something like that. So the Fed had to jump into play, and they didn't make a change in the discount rate for Fed funds at that point. They waited until the next Fed meeting, but they felt at that time, and that was probably appropriate, that to signal that the next meeting they would consider dropping rates. And that this is exactly what they did on this particular day, is that they did drop rates by 50 basis points. Now that's important because that was the first Fed pivot in several years. First Fed pivot in several years where all of a sudden rates go lower. So what do we get from that? We ground our way to marginally higher highs over the course of the next month in October of 2007. And that was the high water mark. That was the high water mark for markets up to that point, because as you can see, after that, we started to fall to pieces. And one crisis after another. That was the Soc Gen bottom. Then we had the Bear Stearns bottom. And then we eventually had the Lehman crisis coming along. And this is where everything really, really fell apart. So it was down 46% by that point in October of 2008. And it continued to get worse into the eventual bottom in March of 2009, when all had given up hope at all. So why am I bringing this up? Why the history lesson? Well, I think we're going through very similar conditions right now. And I think there's been enough time, 17 years, where people have basically forgotten about this. They've forgotten about the patterns and about how markets operate. So where I think we are is, I think we're relatively close to this part here. We may be Maybe here, we may be closer to here. I don't know yet. We certainly have not gone down by 10% yet, at least on the S&Ps. The S&P is down 8.2%. The NASDAQ is down 11.7%. So the NASDAQ is definitely affecting the S&P due to the weighting. So we're close to the bottom here, and we'll talk about potential technical bottoms for this point. But the point I want to make here is that when the Fed does pivot, it usually is the beginning of the end for that particular cyclical bull market. So we know that the Fed's probably going to be dropping rates. If not in September, you never know if they're going to come along with some kind of an emergency rate. If things continue to deteriorate, they will signal an emergency meeting, and then markets will more than likely rally from that point. But the point that I want to leave you here with is that that may be just a sugar high. So we may be rallying up to new highs, and we can certainly take advantage of that in the near term. But this is where people need to be very, very cautious, is what happens after that rally. So before I get ahead of myself here, let's pull back. Let's look at some technical levels of support that we have, especially in the S&P 500, and see where those are and see how we're going to make decisions over the next coming weeks. Okay, so when I look at the S&P 500 chart here, and if we zoom out and look at first of all, the monthly chart on the left-hand side over here, weekly chart in the middle, and then daily chart on the right-hand side, the first thing that comes to mind here is that we need to get a grip, because all we've seen so far is just 3 weeks of downside. Now, I realize that that comes as a bit of a shock, especially after we've had one of the strongest moves in history here, going from 40.95 or thereabouts all the way up to close to 5,700, all the way up to 5,700. Now, this yellow line that I drew some time ago, this shows the measured move target from the cup with handle. And damn if we're not close to that. Just close to 5,600 or 5,800 is about where that is. So we've gotten fairly close to that measured move. And we may indeed yet hit that point. We may indeed yet hit 5,800 if we have some kind of relief rally up here again. That doesn't necessarily put the green light on everything, but again, I think this might help you clear some risk into what might be happening next. Okay, so let's look at where the trends are. Trend is still to the upside on the monthly chart. That doesn't go away immediately. In 2002, that took several months before the trend reversed to a downtrend. This was not the COVID thing here was, I think that's probably a once in a lifetime shock to the system, very similar to what happened in 1987. So the trend is still to the upside. The trend is still to the upside in the weekly chart. This is just a swing down. We do have a downtrend showing on the daily chart with a lower high and lower low combination. Okay, so we have a downtrend there. For the chart to propagate to a weekly downtrend, however, we need to see the price bounce back up to a lower high and then lower low combination. And then ultimately to move to a monthly downtrend, which would be a true bear market, we're going to have that happen as well too. A bounce to a lower high and an undercut. Exactly what happened here in, I believe that's the March-April transition in 2002. So study that. That's exactly what a transition to a downtrend looks like on the monthly chart. We're not there yet. There's one thing we always say, tops are a process, bottoms are an event. Bottoms are an event. We just sort of bottomed out here and took off to the upside. We just bottomed out here, took off to the upside. This is what we see. Tops are a process, bottoms are an event. So we expect to see a very complicated reversal process going on here, which may take several months, if not the better part of a year, before this thing finally releases lower. So what we need to find right now is where support is. And this is where I'm going to pull out the fibs. So there's a couple of ways of doing this, but what I'm looking for ultimately is confluence. Confluence, where we have multiple indicators showing up with the same thing. So let's draw the fibs here from bottom to top, you can see that now from this major swing, which was really the bottom of this swing back in 2023, all the way higher, the price has just come down on Friday to the 23.6% retracement. Now let's map that out with the shorter term fibs from bottom to top, match those. And now we can see that we have confluence. The 23.6 major fib is lining up with a 50% minor fib to provide some strong support at 5,300. That's also mapping out with basically where a swing test is here. This is a weekly swing test, which is just below 5,300. So this level becomes more and more important now. This takes on greater and greater importance. So much like we had an initial reaction at the 38.2 on the minor fib at 5,400 up to a lower high, then a release lower, it does appear that 5,300 is going to be major support. I mean, not factoring in any weird geopolitical activities over the weekend, which we can't control. But right now, 5,300 does appear to be a very strong level of support that is providing some institutional buying support down at this level. Now, what I love to see from these types of situations is when a level becomes very, very important like that, a brief undercut below there really brings out the blood on the street. So this is where people panic sell. This is where institutions will buy. A brief undercut below this, I think, will probably power us up to the next move. And then at that point, again, here, we are not here to predict the future. We're just looking for where the patterns, where support at. So right now, strong support is about 5,300 in the markets on the S&P cash. And also what we're seeing is we're seeing the energy build up very dramatically, very, very quickly. This is doing exactly what the market needs to do. Notice that the monthly chart is in exhaustion and is saying, give me a break. And so this is exactly playing out according to what the market wants. Market says, give me a break. I was going too high for too fast for too long. I need a rest. So if you strip away all the political risk that's out there, if you strip away all the interest rate discussions and the carry trade and everything else on a pure technical basis, if you knew nothing else, then you would say, yeah, this does make sense for the market to take a pause here. Now, the next thing that I need to bring up here is how complex will this correction be? So we're definitely in a correction right now in the S&P 500. How complex will this be? And we don't know the answer to that yet. Back in April, it looked like we were going through another complex correction. That turned out to be one and done, one pullback for 6.5%. And then boom, it was off and running. And that's because we got our first long-awaited weak jobs report back in April. Now, jobs reports that are weak, bad news is bad news again. Bad news was good news back then, and even back into this area. So if we go to a year ago, exactly a year ago, we were doing the same exact thing. This is a complex correction. So we found initial support. We bounced up to the point where it looked like it was going to V-bottom, and then we got our next leg down. We may be in the same place right now. So we would expect at some point where support comes in, we bottom up and head to the next lower high. And eventually, when all hope is gone, this is where this will bottom out. I don't know if we're going to go through another 3-month correction similar to this one. I would say probably not. I would say probably what's going to happen is the Fed is behind the ball. They're behind the curve right now, and they're going to make every effort to catch up, especially with an election around the corner. There's going to be 100 pounds per square inch of pressure on them to do something, to act, and to cut rates immediately. Probably 50 basis points is going to happen. And the question is, how soon will that happen? Will we wait all the way until September to hear from the Fed and Powell about where their rates are going to go? And if so, we'll probably end up selling down before that point. Or Are we going to have the same type of move as we saw back in August of 2007, where the Fed did an emergency conference call and then signaled their intentions to cut rates at the next meeting? And that's how it happened back then. And I would really, really be surprised if they waited until the middle of September to do something. I think that they will start to signal and send out their army of Fed minions out there to do Fed speak and to basically pump the market higher without revealing too much. So what's my bottom line here? I think we may have reached initial support for right now, and then we're going to have to see what kind of signaling that we get from the Fed in the near term. I mean, we just had a Fed meeting last week, so how embarrassing for them to have to come out and alter their policy or accelerate their policy. So I think they're going to probably slow roll it for a little bit. Until that point, we may end up dropping to the next level of support, which is going to be somewhere north of 5,200. So somewhere between 5,200, 5,300, I think is going to be the initial bottom for this. And then we will see the beginning of a strong relief rally based on the expectation of the Fed coming in to save the day. We may end up, before this is all said and done, I think we may end up into this fall with somewhere near 5,800 before this is all done with. And then I would say look out below. At that point, then I think the market is in extremely vulnerable position and we'll be taking defensive steps at that point. All right, that is it for this weekend's Market Minute. Hope that helps, and we'll talk to you in the next one.